So I'm going to go through asset classes. Now, what do I mean by an asset? What is an asset? An asset is a valuable resource or a thing controlled by the owner. So it has to be valuable and it has to be a thing. It can be anything, but it has to be controlled by the owner. So remember that asset classes do not have to be physical. They can be digital, physical. It does not matter. The concept is still the same. And these are just some of the asset classes which I have talked about. You have asset classes which have a fixed income. So as an example for you, think of a fixed deposit account. So think of a fixed deposit. Okay, this is an account where you put a certain amount of money in that fixed deposit account, and then you agree with the bank that after such period you will be getting such a percentage. After let's say 3 months, we'll be giving you 2% from your investment, from your fixed deposit. So your income is fixed. It does not matter whether the bank makes a lot of money from your deposit or whether it loses money from your deposit. That income is still going to be fixed. Another example would be government bonds. If you want to know more about them, just Google, you find out how they work. Another example, you have stocks. So stocks are another asset class. Some of the examples, you have different markets where stocks are sold. In Malawi, you have the MSC, the Malawi Stock Exchange. So this is a place or a platform where companies will register, and once they are registered, individuals will go to that platform and buy or sell a particular stock in order to make money. So they'll buy a stock which they believe it is going to increase in value and sell it to make money. Or they would sell a stock which they believe it is going to crash and therefore they would also make money. You have the New York Stock Exchange and NYSE, New York Stock Exchange, and you have the London Stock Exchange, London Stock Exchange, there's the Sydney, there's the Tokyo, lots of stock exchanges. You have commodities. What are some of the commodities that are obvious? In Malawi, obviously, we sell tobacco. Tobacco is a commodity. We have soya, we have maize, we have cars, we have houses. Houses are part of the real estate market, which is an asset, a real estate asset class, which are part of commodities. You have oil, you have gold, you have metals like silver. All those things are commodities which are bought and sold. Even on the market, masamba, fruits, cabbages, all sorts of things, they are all commodities. Now, you have indices. So these are basically a representation of stock performances. So they are called indices. You can also Google how these ones work. You have cryptocurrencies and currencies. So first of all, currencies are just currencies of different countries. Now, a currency in itself, it has no value. A currency in itself, it has no value, but it has to be compared with the currency of another country. Okay. Cryptocurrency, basically things like Bitcoin, Luna, Solana, Ethereum, and all that. So the other thing that's important to know is that some of these asset classes do not have any intrinsic value on themselves. Things like cryptocurrency, they don't really have intrinsic value in themselves. However, their value comes because of what we believe to be the value of that particular thing. Same thing for currencies. They don't really have intrinsic value. The currency is just a piece of paper. We have kwacha, dollar, they're just pieces of paper, but what we believe that particular piece of paper represents, that's what gives it value. A commodity has value. If you have gold, gold is valuable. It's shiny, it's a precious metal that you can use as jewelry and all that. But Stocks, they're just a representation of a company performance. Not really significant value per se. So that keep that in mind. Now, whenever a certain asset class is hyped, it usually attracts people who have cash but don't have skill. If you remember initially when we talked about how to make money, we said that you need skill plus cash. Okay? But when a particular asset class is hyped a lot, it will attract people who have cash but don't have the skill. Now, I said that people who don't have skill are doomed to lose money. They will lose that money. They are bound to lose. Okay? Think about Bitcoin. When Bitcoin was being established, I think it was in 20, I don't remember. But when Bitcoin was being established, the idea was that it should be a means of exchange. It should be a means of exchange. Basically, it should be money. So it should be a way of me making a payment to someone and getting a particular service. That was the idea for Bitcoin. However, over time, people noticed that because Bitcoin is a limited resource. There is a limited number of Bitcoin. People noticed that those people who had a lot of Bitcoin, the Bitcoin was appreciating in value over time because the more transactions that were being made by Bitcoin, the more people wanted Bitcoin to make those transactions. But because Bitcoin is limited in supply, the price started going higher and higher. Now, as the price is going higher and higher, certain people thought that, oh, if the price of Bitcoin is going higher, then it is better for me to buy it and keep it as an investment. So now it has changed as a means of exchange. Now you're thinking of buying it and holding. Okay, you're thinking of buying and holding. Now all this idea of Bitcoin investment, it started like that. And now people buy Bitcoin just to hold it. However, the idea for Bitcoin was for it to be a way of exchange. Now people don't even have to do anything. People would buy Bitcoin. As an example, just last year, Bitcoin was at $16,000 per Bitcoin. This year, January, last year, December, Bitcoin was reached almost $100,000. That is over 5 times growth. Now imagine those people who bought it at 16,000. They've become millionaires just because of that simple profit. So as I said, some of these things don't have intrinsic value, but over time, the value just comes because of what we believe. Think of tulip mania. Now, this was an issue that happened in the Netherlands. So around the 16th century, a group of traders introduced this particular leaf to the nation, Netherlands. So this thing had an exotic appearance. It's a tulip, and it had vibrant colors. And this captured the fascination of the Dutch. It became so popular. Okay, eventually it became a status symbol among the wealthy. Wealthy people needed the tulip. Wealthy people needed to have it in their homes. Okay. Now, because this became a symbol of status, and the wealthy as well as the elite were having it, obviously you'd expect that the demand started going up, and that's what happened. The demand started shooting up. In order for someone to feel wealthy, they needed a tulip. Now, because the demand for the tulip soared, prices obviously shot up again, shot up together with the demand because supply was limited. So prices started shooting up again. Now you have people from all walks of life, merchants, you have craftsmen, you have farmers. All these people, they wanted to invest in tulips in the hope of making significant profit. So people would buy a lot of tulips. They would order them in bulk so that they should sell it to rich people or people who want to feel rich. Now, think about it. This is just a flower. the price of the tulip soared so high that it even reached a point where the tulip was more expensive than buying a mansion, than buying a house in that time. Now think about it. The price was so high. However, the price was not high because of what the tulip was delivering. It was not a food. It's not something that you would eat. It's not something that you would, something that would make your life better. It was just a flower. Okay, so the value was just based on speculation rather than intrinsic. There was no underlying economic productivity, no tangible asset backing up the tulip, and some investors started to sell their tulip to secure profits. So a lot of people would sell the tulips to secure their profits. Now imagine people would buy all these tulips in bulk and then they would sell them to make a profit. Now around 1637, eventually the bubble burst, and then the market collapsed. And because the bubble burst, people started selling their tulips and people started panic selling. Now, because everyone wants to sell so that it should be out of their hands, obviously the prices started dropping drastically, plummeting, and many investors faced severe financial losses, and some were even bankrupt. People lost their houses because of this flower. It's crazy when you think about it now, but this happens over and over and over. Think about this. This was 2022 May. Elite real estate. You have them selling plots at 1 million. Okay, and when was this? Okay, I don't see a date, but yeah, 1 million near Baron Estate. Okay, fine. 15 by 30, 1 million kwacha, you get a free house plan, free title deed, and all that. People are excited. How many hectares, very interested. All these people are interested. Now you should remember that during this time there was a mania for real estate. There was excitement to buy real estate. Everyone was selling plots at Airwing. People were going to Airwing once they have money to buy land, and it was excitement. Now, May 17, 2022, this post was made. Same month, from May, the next month, June 2022, Independence Day. What do you have? Prices slashed from 1 million to 700,000. Okay, from 28 June to 11th July. Now, during this time, there were a lot of companies selling plots, same area, Baron. This is the same area. Let's see. Oh, I got but it was at the same area. It was plots at Airwing. So this was Airwing, Baron Estate. It was the same location. So now prices are crashing because people are now panic buying. People have been buying land. There are a lot of companies selling. So you know people are selling. But this is the same thing that was valued at 1 million just a month prior to that. And then June, July, August, September. 3 months later, you see that prices have been slashed to 550,000. This is half what the price was a few months ago. Buy now before we sell. Have you checked out our 15 by 30 situated near Baron Estate and all that? So you see 550, it's the same location near Baron Estate and all that stuff. So you see what happens when there's a lot of supply, prices tend to crash. When there's a lot of demand, price tends to shoot up. When prices were at 1 million, people were buying, but then when companies started selling most of the land, then prices crashed. Now, I don't remember when I took the screenshot, but this was the most recent screenshot. and you see that location airing after Byron Estate. You see that now that prices are going back up. It says that when you're making installments, you're paying 700,000. If you're paying cash, you pay 550. So that is just something that happens. Prices of things are based on speculation. If you believe that a piece of land is valued, is worth 1 million, if that's what you believe, and you convince your whole village that a piece of land is worth 1 million, and you all go to buy this piece of land, trust me, the value of that piece of land is going to shoot up. It will reach 5 million, and someone is going to buy it at that particular price. However, if we all agree that this piece of land is not worth 1 million, this price is going to crash. It's going to crash to, let's say, 500,000. Or if you have another company here selling the same in the same area, selling the same size of land, but they are selling it at 700,000, you find that these ones are going to cut their prices from 1 million, let's say, to 600. And then you have another company which will cut it to 500. Now it is your job and my job to identify the trend, to identify how the what is the trend of the pricing. Is the pricing going up? Is it trending upwards, or is the price trending downwards? And you need to buy or sell at the best possible price, which is the 500. All right. Now, the markets, we talked about different asset classes. We talked about currencies, we talked about commodities, stock market. So this is just a graph depicting the daily trading volume. So the amount of money that is moving in and out of people's pockets each and every single day. So you see that the currencies market has about $7 trillion daily trading volume. So it means every day this amount is circulating in people's pockets, trading, buying and selling every day. You have a stock market which has a trading volume of around, let's say, $2.5 trillion, which is almost close to just a bit over a quarter. And then you have a cryptocurrency which is so tiny. You have commodities which are so tiny. So the stock market is small. It's not as big. It will never be as big as the currencies market. So combine all those companies, combine Apple, combine Tesla, Nvidia, Google, all these companies, their daily trading volume does not even get close to the currencies market. This is what this chart is showing you. Now, if the market has a trading volume of $17 trillion every day, this tells you that there is a lot of liquidity. Liquidity. This is something that by now you probably understand, or you will understand in the future. There is a lot of trading liquidity, which means that there is less slippage. Again, something that I'll explain later, but think about it like this. The commodities market has the least amount of liquidity. Think of a house. When you have a house and you want to sell it, you need to find someone who is buying a house. Okay, that can take a day, that can take 2 days. Typically, it can take weeks for you to sell that house. This is what it means. It means that the liquidity is low. The liquidity is low. However, for a highly liquid market, if you want to sell something now, this very second, there will be someone on the opposite side waiting to buy that particular thing. If you want to buy that particular thing, you will find it immediately. You will find it immediately. That tells you that it is liquid. So so highly liquid markets, lots of volume can be traded without actually changing price that much. Now, what I mean is that you have a lot of people that are buying at this, a lot of people are buying at a specific price point. A lot of people are buying. Now you have a huge order of sales. If you press sell, if you sell all those orders at once, you have a huge number of people buying that particular thing at that particular price point. Therefore, price will not fluctuate as much. That is what happens in liquid markets. In markets which are not liquid enough, for example, the example that I gave for the house, if you place if you place a big order, price will change dramatically. That's why the example that I gave for the plots. If you want to buy a plot and you want to buy 100,000 hectares of land, you find that the fact that you need that much land and you demand that much land and you make a post that I want to buy this particular land, you'll find that prices will dramatically shoot up because people will be like, this person wants a lot of land, he will be forced to pay much, to pay more, to pay more. But anyway, that is something that we'll discuss later. Now, market participants, you have banks. Now, when I say market participants, mostly I'm talking about the currencies market, but you also have those participants. Some of them are in the stocks, some of them are in commodities, some of them do multiple things at the same time. So you have banks. These ones, they trade currencies. So if you go at the bank, they'll show you a forex. They say forex, foreign exchange rate. So you see a box and there are a lot of numbers on it, which are always changing every minute. Okay, those are the exchange rates. So if you go to that bank and you change your kwajas for dollars, you'll get your dollars. What they are basically doing, they're basically trading forex because the price that you're going to pay is going to be higher and they will make a profit. Apart from banks, you have hedge funds. So these are basically a group of people who put in their money. They hedge their money, and you have a hedge fund manager who takes the money and then invests it, let's say in currencies, or he might trade that particular money, or he might invest it in crypto or even stocks. You have different financial institutions, retail speculators, that's you and me. You have governments and you have anonymous. We don't even know who trades in these markets. We don't even know the majority. But we know that retail speculators are a very, very, very small minority, very tiny. That is why all of us on this planet, if we are to be trading the forex market, even if each of us got a percentage, I mean, even if each of us got like 1 million of this $7 trillion, would not exhaust all the money that is available. It's not possible. Now, some of the rules in making money. The idea is that you should buy cheap, buy cheap, buy when something is cheap. When something is cheap, that is when you buy and you sell it at an expensive price. That is the idea. If you are selling, you need to sell it when it is expensive so that it drops, so that as it drops, you make money. So you need to anticipate before this up move, you need to anticipate that if I buy here, the price is going to go up and I will exit at the top. If you're selling, you need to anticipate beforehand that the market is going to drop so that you are already in the trade. You do not sell when the market is going down. You sell when the market is about to go down. You don't buy when the market is going up. You buy when the market is about to go up. So as supply increases, obviously price tends to fall, and as demand increases, price tends to shoot up. Basic business. Now the question is, what is cheap? What would you say, what would you consider to be cheap? What is expensive? What is cheap? Now that is why we need technical analysis. We need to look at price. When you look at price, then using our technical methods, we can identify premium and discount. So we can identify what is expensive and we can identify what is cheap. We want to be in trades which are in our favor. We want to be buying when price is cheap. You don't want to be buying when something is expensive because you will lose money. and you don't want to sell when price is cheap because you will lose money. So, are you a trader or an investor? Basically, what's the difference? A trader is someone who tends to buy and sell and wants to be done, say, let's say in a day or maybe in a couple of days or maximum a week, and they want to make their money. An investor is someone who tends to put in their money into something and they hold for weeks, months, or even years before they see any profits. Generally speaking, traders make more money faster. Investors make um, small amount of money over a long period of time. Some of the things that can determine whether you are a trader or an investor could be that how busy are you? If someone who has a full-time job, very busy, it's easier for them to it's easier for them to just invest their money into something and watch it grow over time. So generally, rich people tend to be investors because they don't really have time to be on the trading screen or analyzing charts and all that. But since we are different people, some people they are traders, but they hold their trades for a couple of days. Yeah. All right. So you need to be able to read financial assets. You need to be able to read financial assets. What are currency pairs? You know, what pairs do you trade? You need to know how to read a quote. What are pips? How do you even measure pips? So these are the things that I'll talk about in the following trades. In the following slides. Personally, I trade synthetic indices for the most part, but I also trade currencies. Sometimes I trade in indices. So synthetic indices and indices they are different, but I trade those things. Indices, synthetic indices, currency. Sometimes I trade gold. So gold is a commodity. All right. All right. So this is a chart of the Malawi Stock Exchange as of 24 August 2022. So let's just focus on one company. Let's look at Airtel. Now, on this particular day, what we are seeing is that price opened at 51.1 kwacha. All right. 0.1 kwacha. It went as high as 51.12, and the lowest that it went was 51.11. This is the highest. So let's say price opened in the morning. It went as high as 51.12 there, and then it came down to 51.11 and then it closed. Now this is now the volume of the trades that were taken during that particular day. 515 shares. That is Airtel. Now if you look at 1 year later, so this is 1 year later, you see that price opened at 107, made a high of 107 and a low of 107. Basically, price did not move on this particular day. However, this is August 2023. So it tells you that from in 1 year, the price of Airtel has doubled. So if you had invested any amount of money, let's say you had bought 100 shares in 2022, by 2023, those 100 shares would be worth 200 shares. So if you want to make a profit, you need to sell back those particular shares to someone else who wants to buy. That is the only way you'd cash out. Another example, let's look at National Bank of Malawi. National Bank of Malawi Opening price on 24 August was 1,140, and that day the price stayed the same, it did not move. 1 year later, what happened? NBM 1 year later, you see price is at 2,050. Okay, so price has moved almost 100% as well. The stocks have doubled almost 100%. Now, something that I should show you. Airtel has doubled, National Bank has doubled. Look at NBS. NBS opening price was at 22 kwacha. So this is the price when the market opened in the morning. He didn't move that particular day, price was the same, 22 kwacha. However, in 1 year, the share of NBS was now 128. Okay, 128. This is not a 100% increment. This is over 1, 2, 3, 4, 5, over 6 times increment. Okay, so if you had bought shares of NBS in 2022, you should be sitting on 6 times the amount that you invested. So if you had bought shares, 100 shares, those 100 shares should be worth 600. I mean, or 100 times 6, yeah, should be worth 600 shares. So if you cash out, if you sell those shares, you will get 6 times what you invested. Now, NBS is a very good example why you should not look at shares which are doing good. You do not look at you do not look at companies which are doing good. All right. Remember about what about the tulip. Remember what I talked about hypes. You should not enter into something because it is hyped. Right now there was a hype around FTH. There was a hype around Airtel and all these things. Usually, money is being made in silently. By the time you're hearing the hype, the money has already been made by some people. So the idea for you is that you should analyze the data given to you. Look at the company, look at what it is doing, look at the price trend, look at the investment that particular company is making, and then you can buy those shares before price starts moving up. So if you had bought NBS shares at 22, you'd be sitting at a bigger profit compared to the person who bought Airtel shares or National Bank shares. As much as Airtel is, it has the reputation that it does very well and all these things, but you see that NBS did very well, but you don't hear anything about it. So another thing, look at Mpico. Now, someone could have bought shares Mpico at 20.69 here, 20.69. 1 year later, how much would their shares be worth? 20.58. What has happened? Nothing. They have lost a bit of money even, but nothing. So in 1 year, they have made nothing because they thought that in just buying a share, then you're going to make money. But it doesn't work like that. You need to buy something when you are anticipating its value to shoot up, and you need to sell something when you are anticipating its value to drop. Yeah, so see, look at these big companies. Airtel doubled. TNM, let's see. TNM 29. So 12 to 29. TNM also doubled. Look at Sunbird from 80 to 190. Sunbird doubled. Standard Bank from 1840 to 240. Sunbird has not doubled, maybe half an increment. PCL 2181, PCL 2508. Very small increment. Nico, this is 46.73. Nico 163. So you see that Nico has also dramatically increased almost 4 times its value. Now, if you had known this beforehand and you wanted to invest, you would have invested in number one, NBS, because this one you would have analyzed and seen that okay, NBS is going to make a lot of money, and you would have bought Nico, and you would have stayed away from big and fat companies because it's not just about being big and fat. You need to make money. Look at FDHP. I don't know what company this is, but it's at 14. In 1 year, it's at 66. That is the performance that we're looking for. Because the amount of shares that you bought here, they would have multiplied multiple times by the time you're selling here. So that is the idea that you should keep in mind. So there are two ways of analyzing. You can look at fundamentals, you look at news, you look at interest rates, you look at what the company is doing, who is the director, you look at GDP and all these economic things, fundamental analysis.